So, our next speaker is Keith Arundale. Dr. Keith Arundale is a senior visiting fellow at the ICMA Center and specializes in private equity and venture capital. He lectures on MSc degrees in corporate finance and entrepreneurship and financing with responsibility for the module on venture capital. Keith was with PwC for many years, where latterly he was in charge of the venture capital program and marketing and business development for PwC's Global Technology Industry Group in Europe. Since leaving PwC, Keith has been pursuing a portfolio career of teaching, training, and consulting in private equity and venture capital, together with non-executive roles. And he will be presenting an investigation for the past year on the investment practices of venture capital in China. Keith, all yours.
Thank you so much, Nicholas, and it's great to be associated with Global Corporate Venturing for, I think, since the formation as a delegate, because I found it really useful in terms of generating contacts for my research, which has been really fantastic. So thank you. So I'm going to talk to you today about the Chinese research, which follows on from a much more extensive study of European and USA VC investment practices. And I've been doing this in conjunction with a colleague of mine from the University of Chester Business School, Dr. Ying. So I've got a little quote here. "The Chinese are just crazy people. We spend all of our time working." So says the founder of the Chinese VC firm Sky9 Capital in an interview with Real Deals magazine recently. He went on to say that Europe would never catch up with the VC market in China due to Europe's inherently lazy working culture. So there we have it. We've been told. China is fast, basically, as we will see. So there's been relatively few studies on the investment practices of Chinese venture capital firms, with it being a relatively new industry and a new area for academic study. I'll be looking at the structural aspects of venture capital firms in China, also the operational aspects, the investment practices basically, all the way from generating deals to exiting from deals, and then the wider environmental aspects as well, including culture, propensity for risk, and things like that, basically. And hopefully we can come out as a result of this study with some best practices for investing. This is what I did with the European and US work, came up with a list of best practices. If you were setting up a new VC firm, how might you set it up? I've got a little bit of data here, but I know that Martin Hemming is going to cover a lot more on this in the next talk. But just to show basically just how significant China now is, or at least Asia-Pac, and China is the major portion of the activity for Asia-Pac here, you can see it's very close behind North America, and USA being the largest part of that. Europe is way behind in terms of VC investments, both in terms of the number of investments and the actual amount. So just wait for the alarm to finish. Okay, hopefully it's not a real alarm. And fundraising has increased enormously globally in 2021. Despite lockdowns and the pandemic, both funds raised and investments have increased substantially, as you can see there from that data. In fact, for the full year 2021, VC investment globally was a record high. In terms of China, the activity in 2021 was a little bit short of what we saw in the peak year of 2018, but still nevertheless very significant. As I mentioned earlier, Martin is going to give you an update for Q1 2022 very shortly. If we look at previous work that's been done in the area of Chinese investment practices, it didn't really start until around about the year 2000 because it is quite a young industry. And they've mainly focused really on the role of government in venture capital in China. And whilst the typical limited partnership model is used by foreign venture capitalists in China, I think it's fair to say that VCs, domestic VCs, are structured more as limited liability companies. And the domestic VC firms are basically state-owned subsidiaries or spin-offs from local governments or large corporations or universities. The government-backed VCs are much more focused on innovation and creating employment in the many tech centers set up all around China, and there are hundreds of tech centers now around China. The independent VCs are much more interested, of course, in returns. And I think it's fair to say from the previous studies that, generally speaking, it's the foreign VCs actually who are achieving better returns than the domestic government-backed VCs. And the studies also focus in on the importance of relationships in China, so-called guanxi, and maintaining face or respect, is mians. This is very important in conducting business in China, this relationship development. So my framework, my conceptual framework, really bringing out the structural, operational, and wider environmental factors. There are a number of theories which are relevant, which I won't go into today, but if anyone's interested, I'd be very happy to share the paper that goes around this study. There are basically three types of funds in China. There's the independent-owned, onshore domestic funds, the government-backed funds, and also the foreign funds operating in China. Now, in my sample of Chinese venture capital firms and other stakeholders, it is just a preliminary study at this stage. I'm hoping to get a lot more in my study. If there's anyone here today who's got any contacts with Chinese VCs, I'd love to hear from you. It's not that easy setting up the interviews. But so far, I've had discussions with 29 separate people from venture capital firms, some entrepreneurs, other stakeholders who know a lot about operating in China venture capital. We do have an informal arrangement now with a leading Chinese university, Liaoning University, who are going to be carrying out interviews locally as soon as the lockdown is lifted. And venture capital in China is very much concentrated, actually, in the three key centers here, Shanghai, Shenzhen, and Beijing, and they travel out to the many tech centers that are around the country. The US and European study sample was much more extensive. Something like 64 separate interviews I conducted with venture capital, senior partners, investment partners, many parts of the US, also the UK, of course, and continental Europe. And then 40 other stakeholders, including limited partner investors, entrepreneurs, and 6 corporate VCs as well. So let's have a look then at the headline findings, if you like, the preliminary findings, as I stress. Comparing China from the current study with Europe and USA from the previous study. So I said things move fast in China. Consequently, the fund life is much shorter. We have a typical 10-year limited partnership fund life, 2-year extensions. In China, it's 5 to 7 years. The performance of the funds in the sample, whilst it's a limited number of funds in the sample, you can see the range is not quite as extensive as we see in Europe and the USA. USA, of course, having some quite stellar returns. The source of funds coming from government, large corporates, even wealthy individuals. Here in Europe, we have been quite dependent upon government sources of funding from the EIF, particularly in the UK prior to Brexit, and then the British Business Bank as well, with British Patient Capital more recently. Because, as we heard from Saul Klein earlier, the pension funds haven't been putting very much money to VC in the UK, whereas the USA is getting a lot of money from the pension funds, as well as university endowments. Looking at the backgrounds of the partners working in the firms, quite a mixture in China, coming from an investment background, a finance background, an accounting background, but also with operational and entrepreneurial backgrounds as well. Historically, we've been much more investment and finance focused here in the UK, but this has changed quite a lot, I think, in the last few years. Whereas the USA has always been much more operational and entrepreneurial focused. Quite a collaborative working style in China. Perhaps here in Europe, it's more sort of one partner being responsible for a deal all the way through. I found in my study that in the USA, you might have two partners working on the deal, perhaps a bit more sharing around. And in terms of the stage of investment, interesting that the government seems to be focused more on the later stage funds, when you would have thought they'd be very interested in early stage deals, but they don't like to take the risk of losing money. So a lot of the early stage deals are dependent on the foreign VCs and the more independent VCs in China. Some firms have teams of functional experts working alongside the investment partners, a bit like Andreessen Horowitz has in Silicon Valley, for instance. Some engage advisory boards of technical experts. And the sectors that they actually invest in are determined a lot by the relationships they have, rather than necessarily finding the best sector that they might choose going forward. So consequently, you've got a quote there from one of my interviewees. They end up all over the shop, basically, in terms of their sector approach. If we look at the operational differences, which is now taking us from doing deals all the way through to exiting deals, if we look at the approach to risk, as I mentioned, it tends to be fairly low risk for the government-backed VCs, a higher risk approach for the independent and foreign VCs. USA takes the highest risk, I prefer to say. Basically, it's a how do I win approach in the USA, whereas a how do I not lose approach in Europe. Deal sourcing coming from personal networks, relationships, the guanxi. Here in Europe, we tend to be quite proactive going out and finding deals. In the USA, because the venture capital firms tend to have quite high profiles, entrepreneurs tend to come to them quite a lot. Due diligence in China, done in-house. We tend to use more consultants for due diligence here in Europe, and the US is mainly in-house, I think it's fair to say. Now, when it comes really interesting, when we look at the investment committee, who actually approves investments? Here in Europe, we have mainly the investment partners, but also sometimes some external people coming and sitting on the investment committees. In China, they may well involve some of their major limited partner investors. Even the government may come and get involved in making decisions. In the USA, however, just about every VC firm that I looked at, it was only the investment partners who actually made decisions. In fact, I spoke to some LPs investing in US VC who said they would only fund venture capital firms who had the senior partners making the decisions. How do they make the decisions? China, possibly by majority vote. But also a senior decision maker can veto a deal. Here in Europe, we tend to have either a unanimous basis or a consensus basis. The problem with consensus, where everybody has to be comfortable in doing a deal before they actually do it, means that you can, basically, you don't do the outlier deals, you don't do the really high-risk deals. Whereas in the USA, they have a situation where senior partners can actually railroad an investment decision through if they want to. And this means that some really risky deals can be done, which is possibly why we have companies like Facebook being invested in and so on. Investment terms, really quite draconian in China, very investor-friendly, as opposed to the entrepreneurial-friendly West Coast terms used by Silicon Valley VCs. And they're quite informal in terms of how they go about monitoring their investments. They tend not to actually turn up for board meetings very much, but they do have a lot more in terms of social events where they talk to their portfolio companies. They do carry out formal portfolio reviews, though. They're like quick exits. As I said, everything's fast in China. Short investment period, selling to state-owned enterprises and listing on the stock market. So just a comment here about the draconian investment terms, if you like. Even the use of negative ratchets in China. And they might even have to, companies might even have to pay cash or equity compensation to the VC if they don't meet their targets. One of my interviewers commented that they're the most strict investment terms that they've ever seen. Syndication is very common with foreign VCs. They want to syndicate because they don't want to risk too much money themselves, but also to share the resources and expertise from other venture capitalists. And as I say, IPOs on the new Shanghai and Shenzhen Stock Exchange, STAR market is quite prevalent, as are sales to large corporates also. So just to finish, really, culture, it's very much a get up and go attitude in China. A bit like the US thinking big approach. And they tend to be located in the big centers, the financial centers, as opposed to in the tech centers. So I'm running out of time, so there are a few implications here in terms of sharing best practices and so on. Well, I guess what does it mean for anybody here who is looking to think about getting venture capital from China? Something like 10 to 12% of all Chinese VC investments are overseas, so there is a possibility. Just be aware that the Chinese work in very short time frames. It's all very fast. They want returns on their investment right away almost. And do have a good contact who you know really well, who knows the Chinese really well, because guanxi really matters in China. So thank you very much. And if anyone's got any contacts with Chinese VCs, I would love to hear from you. Thank you.
Thank you.